Right. The sky is falling. The sky is falling. Men, the sky is falling. Men, the market's going to crash. Men, should I buy or not buy? Since Wells Fargo announced that they are freezing personal credit line, my DMs, my phone has been ringing off the hook asking me, is the market going to crash? What's going on, guys? My name is Minh with What's a Mortgage. Welcome to our channel. The goal of our channel is to educate, empower, and to connect you with the right mortgage. And tonight, we're going to answer the question everyone's been asking since Thursday. What is going on with Wells Fargo's credit line being frozen, right? Is this the sign of the market crashing? And tonight we have special guest Daniel Aziz. He is a market specialist who helps people with short-term and long-term investing. He watches the stock market like a hawk, right? And he tells us what's going to happen, right? He tells people what's going to happen. So tonight he's going to come on and explain what is going to happen with Wells Fargo freezing credit line and what does it mean, right? So hopefully you're having a great night, guys. If you're not following us, do me a huge favor. Hit the subscribe and follow button so you're notified every time we go live or post new content. We go live every Monday night at 9 p.m. and we talk about the now situations in the market. Also, we post content daily on Facebook, Instagram, and TikTok. So if you're not following us on Facebook, Instagram, or TikTok, definitely follow us and see our updated strategies that we put on there on how to get into a home smoothly, quickly, and in a simple way. All right, guys. Also, if this video does bring you any value, do me a huge favor. Save this video, share this video, and like this video. All right, guys, let's get into it. But first, before we bring Daniel on and we go over how is this going to affect the market, the stock market and the housing market. Before we get to that, what is a personal line of credit, right? What does that mean to you? So, first of all, a personal line of credit is very similar to a credit card, but you don't have to go out and get a card. It's like a blank checkbook, right? It's kind of like a home equity line of credit, but there is no, it's not tied to anything, okay? So there's no collateral. So the bank is giving you a line of credit based on who you are and who your profile is, right? So it's not like a personal loan. When you get a personal loan, right? Typically, personal loans are bad loans, right? They're high interest rate and you're paying on the debt right now. That is a personal loan. A credit card is like you get a card, you swipe it. A home equity line of credit is tied to your mortgage. A personal loan is a loan the bank gives you, like a blank checkbook, right, with a certain dollar amount on it, and you can go out and write checks, right? It's like a credit line, home equity line of credit, because when you pay it off, you can use it again back and forth, back and forth. So that is a personal line of credit. Who gets these personal line of credits? Not majority people, right? So it's not given to the lower class, the middle class, or the upper class. It's given to the elite. So when Wells Fargo is shutting down personal lines of credit, it's affecting the wealthy of the wealthy. To get a personal line of credit, you have to have $50,000, $100,000, $200,000 in the bank with that specific bank. They underwrite the file like you're getting a mortgage. It's not that easy to get a line of credit, okay? They have very low interest rates with no collateral. That's why people love them, right? But it's like an insult to these wealthy people right now, right? They have a couple $100,000, $1 million, maybe 50, maybe 75,000, right? Whatever they have in the bank, right? And you're telling them their money's no good, that you don't trust them. It's more like a spit in the face right now. So anyone who's being affected by these personal lines of credit is the wealthy elite. What Wells Fargo just did was just slow down and stop their spending power, right? They had the ability to take these lines of credit to go out and make money with it or pay down debt or do whatever. So typically wealthy people, when they take these lines of credit, they cash them out. A lot of them are putting it in brokerage accounts, right? So they can borrow on margin. And Daniel will go over it. That's why these margin accounts on the stock market is leveraged to the hill right now, because people are taking these lines of credit to put in brokerage accounts so they can day trade. Also, some people are taking this money and buying property with it, right? And they're making more on rent right now than what they're paying on interest on this money. Okay, so what Wells Fargo is doing is like, hey, let us put a stop to this. And the people it's affecting the most is the rich of the rich, not the lower class, not the middle class, not the upper middle class, but it's the elite wealthy people who are being affected by this. So before you go out and think the world is falling, Jesus isn't coming back, right? The world is going to come crashing down. Just know that right now, short term, it's affecting the upper class, right? The upper class on spending money. Okay, so now you guys know how these lines of credit work, and we went over who can get these line of credit. Let's go over what is it going to do to the market. Will it cause the stock market to crash? Will it cause the real estate market to crash? What is going to happen with your retirement, right? What does this sign really mean? Or does it mean anything? So let's bring Daniel on right now, right? Daniel Aziz, our financial strategist. He will be on a little more often now, right? After this month, I'm going to try to have him on as much as we can so he can help the What's a Mortgage team and the Wham fam and the Wham squad have a strategy to build wealth. All right? What's going on, Daniel? How you doing?
Having me out today.
So share us a little about who you are, what you do, and everything before we get into why we should listen to you.
Well, well, I've got into this. I started about 6 years ago, just learning everything I can about, how the market works, the economy, all that, whether on like a macro scale, micro scale, strategizing, figuring out the best strategies to hedge against all sorts of risk, right? Whether it's, inflation risk or whether it's a market risk, so on and so forth. There's a lot that's been going on recently, ever since COVID hit last year, and everybody is looking at this thing like, why are they starting to cut off money supply? Even though lately there's been a lot of stimulus going on. It's not something we would be too worried about right now. If we were to guess as to why this is starting out, it's so that we can control some sort of inflation, because there's been a lot of inflation recently at 6% so far, which is much higher, like 3 times higher than the target of 2%. So we could say it's not a bad thing that they're controlling the money supply in that sense. However, it is just Wells Fargo. It's not all the other banks so far. If we do see other banks doing it, then we can kind of tell that it's not just Wells Fargo doing it. But right now, just because it is only Wells Fargo, we can also assume that it could be that they're just trying to reduce their risk. If they see that maybe they have an outlook on the economy coming up that we don't know yet, or other banks haven't caught on to yet. So I'll leave it back to you with that.
So I talked to a couple people from so I have a friend who is a wealth manager from Wells Fargo. I can't say her name because she would get in a lot of trouble.
Yeah.
So they told her, because I call it A so and so, right? She actually is one of our clients as well. I asked her, hey, tell me the real deal here, girl. Oh, I think I just said she's a girl. Right? Tell me the real deal here. She said this. What they want to do, what Wells Fargo wants to do is they're trying to get people away from personal line of credit. They're not making enough money, right? Also, they can loan that money to more people. So when they allot these lines of credit, even though they're not using it, they still got to have that money available in case someone wants to use it. If you're not using the line of credit, they can use that money and lend it out to other people on higher interest products, which make them more money. Personal loans, credit cards, car loans, mortgages, right? Which pay more interest and have somewhat collateral.
Yeah.
And no collateral, they pay way more interest. And right now, they're just changing up their products. They're trying to thin out the products so they can present these people to borrow money at higher interest rates. And because they need to make money, that's what she told me. So she says everything is fine with Wells Fargo. They're just changing products to make themselves more profitable.
Yeah, so it's just a company-specific situation. It's not, something to be concerned about in terms of, economic outlook, if that's the case. If that is the case, they're just trying to increase their, profits, basically. So I wouldn't worry too much about that. But yeah, there has been a lot that's been going on recently as in terms of like money supply. I think we're going to be bringing up that chart pretty soon and so on. So, I'll leave it to you to kind of like go into it.
So right now, everyone's biggest concern is okay. So Freddie, so if you have questions, please ask. I hope this crash because prices are ridiculous.
Yeah.
I think there's more people, Freddie, who want the market to crash. If there's that many people who expect the market to crash, don't forget if these homes hit the market, the demand would drive the prices back up. Yes, there's a lot of guys who are complaining about prices are too high, but there's people out there right now who qualify full doc, right? You guys, some people might not qualify, but there is a lot of people who qualify. And understand this, right? I know I'm a big numbers guy. Lately on TikTok, everyone's trying to call my bluff, but let me break this down to you, right? So if they are pulling back from personal loans, right? One thing they should be pulling back from is home equity line of credits. Right now, you can go to Wells Fargo and borrow up to 85 to 90% on a line of credit, on a home equity line of credit, which is tied to collateral. So if the market, if they were becoming conservative, they would stop with home equity line of credits first, right? If they are nervous about housing crashing, they would not loan you up to 85, 90% of the value of your home cash out. That would say I am becoming conservative because I'm not going to loan you money. Your home isn't worth, right? That's why I don't want to even give you collateral on it. Number two, mortgage insurance. They're still loaning homes with less than 20% down. Chase was the only one who wasn't during the pandemic, but now they're going back to 10% down again, 5% down again. So if these banks were becoming conservative and your home ain't worth, right, they would not give you money in a declining market if they're expecting the market. Those are conservative signs. Also, if you're refinancing and you have 20, 30% equity, there you get appraisal waivers right now. If the market is tanking, why would you loan you money without doing an appraisal on your property? Okay, so I think this personal line of credit is a sign of something, but all the other signs don't add up, right?
Exactly.
Yes, if everything else was pulling out, well, this is the first sign. We will see, right? Are all the other banks following suit? We will see. We don't know. So right now with inflation, so let's get back into inflation. So what do you think about what Wells Fargo is doing with the? So you talked about inflation, right? So why do you feel that Wells Fargo have to taper on these personal loans because of inflation? Can you explain that a little bit deeper?
Well, it's a way of controlling spending, basically. The way, we all know inflation, how it works. So if we look at like the money supply, like the M1, which is basically the most liquid form of cash in our system, we'll see that it's dramatically past year. They've just been printing a lot of money for people to spend, and you got the U.S. government handing out, all these stimulus packages to kind of help out with everybody that's lost their job, that haven't been working, that are staying at home. So spending hasn't decreased; it's increased. And when you have so much money in the system all at once, assets are just going to absorb all of that. Housing, stock market, anything else like debt, it's all going to absorb it and it's going to go up in value. That's why we've seen such an increase in property values, such an increase in the stock market, is because there is money in the system. Even though the economy kind of slowed down, we've been printing a lot. So the way to control that is to kind of increase interest rates, make it harder for people to borrow money, restrict borrowing. So when you do that, spending decreases, and when spending decreases, the demand for assets goes down. And when that happens, you just kind of control inflation, a little bit. You don't want too much inflation. 2% is usually the target. Right now we're at 6, which is
wow, that's high.
Yeah, that's 3 times. You look at it percentage-wise, like 300%. Of what we ideally want. So I feel like if we see more banks doing the same thing that Wells Fargo's doing, then that would be a sign that that's what that's the reason for it, is to kind of control spending. But if it's just Wells Fargo and it stops there, then that's just a company specific situation, and I wouldn't be too worried about it. And honestly, if that is the case where they're trying to stop spending or like slow down spending, it's good for everybody. Because if you don't, things are going to keep increasing to such a level that nobody's going to be able to afford much anymore. And that's the problem with inflation is you got to keep it low enough.
Yeah. So what Daniel's saying is that with Wells Fargo regulating their personal line of credit, they're trying to slow down spending to
Could
slow
be,
down
could be,
inflation. Of
could be.
course, if they're giving everyone a free for all on spending, just like they did in 07, 08, right? In 2007, 2008, people went crazy. 100% financing, 600 credit scores, stated loans. People went crazy, right? Because they went crazy because human nature is to keep
Want
spending,
more.
absorb, take.
Yeah, you want
I'll give
more,
me
you want
more.
more, you want
So
more.
if they don't taper off, right? I know I'll answer that question. If they don't taper off the spend or raise interest rates, people will keep spending. So he believes Wells Fargo's doing this to slow down the spending. Okay,
Could be, yeah.
could be that reason. Jolene, what's 6%? It's inflation right now is at 6%. I don't know when was the last time you guys went out to buy dinner. A family of 3 or 4 is over $100 easily now. How much does it cost to fill up your tank of gas right now? Right?
Yeah.
It is crazy right now with inflation. If you didn't know that, you must live in a shell and not walk outside the house. Because have you ever bought toilet paper? Oh my, I think twice about wiping my bum right now. I'm like, man, every time I wipe my bum, it gets too expensive, right? Maybe buy a bidet, right? I'm just kidding. But definitely because of inflation, that's what's going on right now. So when do other banks typically will jump in to like follow suit?
If that is the case, we wouldn't know. We wouldn't know. I mean, we don't even know if that's the case. What I'm saying is, if we do see later on, like within the next few weeks to the next few months, other banks doing the same thing, then that's an indicator that that is the reason why they're doing it. If we don't see them doing it, then we just know it's Wells Fargo trying to, move their products around to increase revenues and their profits. So we can't really tell until we see what the rest of the industry does.
Mm-hmm. So right now, as you are out there seeing the stock market, where do you see things are at? So we talked about leveraging, right? So
Yeah.
we talked about these margin accounts. So right
Yeah.
now, so what a lot of people do with these personal loans. So if your guys out here answering questions like, "Oh my gosh, it's gonna affect me or not affect me," right? So to get a personal loan, right, which means there's no collateral, they're gonna make sure you have some hefty money in their bank. So to get a personal loan from Wells Fargo, to get some money, you might need 50,000, 100,000, 200,000. It depends on how big your line of credit is, right? And what most people are doing is they're taking their line of credit, they're either buying properties or they're taking their line of credit and putting in brokerage accounts so they can borrow on margin, which means just like they have their money in Wells Fargo, right? So because of X amount of dollars and their profile, their credit, how much they make, right? They underwrite it, not just like here's a line of credit, right? So once they do all that, they're going to loan you some more money, right? They're going to loan you more than you have in the bank with them. And then what rich people do, they take that amount of money and they move it into a brokerage account so they can trade daily. If you can trade daily with a money account, but in a margin account, you need to have at least $25,000 in there. But of course, if you're trading at a higher level, you need more money in there to trade on margin, just like collateral, right? So it's a domino effect. So now, if you look at where the stock market's at, where margin accounts are at right now, that people are over leveraging. So where do you see the stock market right now?
Right now, this is a very simple one. It's definitely overvalued right now. We see if we're looking at the margin that there's been so much money being pumped into the market, it's just been driving thing up right now. I believe Amazon is doing a 4-to-1 split or a 5-to-1 split just because of how high their stock price is.
What does that mean? A 4-to-1 split or a 5-to-1 split?
Basically, for every one share you have, you're gonna pretty much get 4, and it's gonna get divided down by 4 of the market price because it's so expensive. People can't afford to invest in Amazon right now. Like Berkshire Hathaway, for example, is a couple $100,000 a share. They're not doing a market split because they don't want people buying their shares, right? So if a company wants to promote, purchasing their own shares, they will try to decrease the price, and one way to do that is to split down that price. And by splitting it, you're basically giving 4-to-1 of whatever you're holding, or 5-to-1. It just depends on how they calculate it. So right now we are definitely overvalued. Because there's so much money being pumped in, but we're still kind of slowly recovering. There's market activity isn't that high right now.
What
We're
does that mean?
slowly
Market
getting
activity is not that high.
spending, like fly, vacation, buying new cars, for example, like used cars. If we look at the inflation, that used car prices have been going up way faster than new cars because less people can afford new cars now, and everybody's buying used cars. Like they're just recycling them, so the demand for that is much higher. So if we're constantly recycling old cars, you've got like Toyota, BMW, Ford, and all these companies. They're losing money because you're not buying the new F-150 anymore. Now you're just buying the used one again, right? And everybody's constantly going back and forth over the old cars. So I don't believe revenues have increased as much as the market price. So if you look like price to earnings, they've been going up.
Mm-hmm.
Price to earnings is basically like where's the price for every dollar earned on a stock in
Mm-hmm.
revenue. So right now, I do believe we are way overvalued. But then again, also like things are starting to open up. So in terms of saying whether or not we believe there's a crash, there's a high probability of one. But if things start opening up and the economy gets back on its feet as quickly as or as strong as it was before, then we might just even out. We might not have like a sharp decline.
And I have something to say to that. So like right now, we're at close to 6% unemployment, right? 6%. We started at 15 during pandemic, and it's 6. So you guys, everyone who's like throwing songs hate about, oh, I see that we're spending. If there wasn't for a pandemic, you guys would be singing a different tune. Because of the pandemic, they printed a lot of money. So for every action, there's a reaction. I think, if I was president, I would have verified everyone I sent money to. But they didn't do that. They gave money to everyone, even if they didn't need the money. They're like, you know what? Let's just throw everything against the wall and hopefully it all sticks, right? So because of the pandemic, before the pandemic, the economy was great. But during the pandemic, now they're printing all this money, right? But remember, unemployment went from 15 back to 6%.
Which is
right?
great.
5.9%, I think it is, right? But also remember this, guys. There are more job openings recorded historically than there ever has been. There's 10 million available jobs right now that people are not taking. A lot of people are creating their own jobs with DoorDash, with Uber, with Postmates, right? A lot of these delivery services, right? People creating their own jobs. That's why you see this unemployment rate is up. Like, why are people going back to work? They're talking about jobs that are out there for hire. They're not counting the job openings that people are creating themselves by just going there. I want to do DoorDash. I want to do those type of jobs, right? So people aren't taking that into consideration. So with 10 million jobs available, unemployment's at 6%, right? Right now, unemployment benefits are skyrocketing still, right? Yes, a lot of states are like, we ain't playing this game anymore. Get your butt back to work. So the last week, right, a lot of states are like, no, bye, Felicia. Go back to work, right? We're not playing unemployment. But there's still a lot of states, mostly you guys know, Democratic states, right? I'm not picking sides. I'm just pointing it out, right? They're still paying high unemployment checks. So, of course, California is different. But if you're in the Midwest and you're getting you're getting 600, 300 bucks a week, right? And now you're getting that child care check, right? Why would I go back to work, right? So that's the reason why a lot of people, if everyone went back to work, that unemployment would drop under 6%. Okay. And we don't know, right? But if they go back to work, is that enough money to live on with the inflation today? That we do not know, right? But I think a lot of all these numbers are really pumped until after September. So you said earlier that there's a high chance the market crashes. Okay. So there's 3 reasons, and I want to go this with you guys. Right? For if you're a realtor, a lender, you're thinking about buying, right? And everyone wants to pretty much school you all the time. Let me school or educate you guys, and then help me answer this question for the third one. There's 3 reasons why people think the housing market is going to crash or bubble. Number 1, forbearance. When all these homes hit, when September happens or end of July, September happens, all these homes are going to hit the market, and there's going to be a crash because there's going to be a flood of inventory. And let me explain this to you. There's 1.9 million, 3.76% of homes with mortgages, right? In mortgage forbearance, 1.9 million. Only 450,000 homes in the United States have negative equity. Okay? 450,000. But out of that 450, we do not know who's not making their mortgage payment. There's 1.9 million, but only 450,000 have negative equity. And I was wrong. It's not Missouri. It's Illinois, Iowa, Oklahoma, and Louisiana. These 4 states hold majority of the negative equity in the United States. That 450,000 are carried mostly in those 4 states. Okay? So 1.9 million in forbearance. Only 450 have negative equity. 38% of Americans own their house free and clear. 62% have mortgages, right? 85% of Americans have more than 20% equity. That means people, statistics, majority of people who have more than 20% equity, their mortgage payment is cheaper than rent. So if everything crashed, do you find a way to suck it up to cover your mortgage payment, or you let your house go into foreclosure and you find a place to rent and pay more than what your mortgage payment is? Come on, right? Also, well, how about all the people buying houses right now? In 2021, it is recorded on CoreLogic or National Association of Real Estate, right? And CoreLogic, 1 out of every 4 homes bought in 2021 is paid in cash. If there is a turn in the market, how would it happen if 38% own their home free and clear, 85% have 20% equity? 1 out of every 4 people buying homes right now are buying it cash. So for the market to crash because of forbearance or foreclosure, yeah. Also, the guy trying to buy a house, it's been 1 year, I'm trying to buy this one house, right? Guess what? He has not made a mortgage payment since Obama's been president. They haven't foreclosed on that guy yet. You think they're going to come look for the person right now because of COVID and he can't make his mortgage payment? He's going to live in, he or she, or they're going to live in there for another year or 2 years. The courthouses are backed up. It's not easy because someone missed 4 mortgage payments that can foreclose on you. Also, if your mortgage, it's time that your forbearance is up, some of these Instagrammers or TikTokers are saying, oh, they're gonna come after that money. They're gonna let whatever you owe becomes a second. They're not gonna come after that money. You're gonna start making your mortgage payment. They're even refinancing those people. So theory number 1 of forbearance or foreclosure, scratch that. Number 2, we just talked about it. Unemployment's at 6%. There's 10 million jobs. People aren't taken until after September, right? So it's not unemployment. But the third one, I'm afraid of the third one even, right? I'm afraid of the big bad. What happens, and that's why I have Daniel on here, if the stock market crashes? Will the stock market cause the real estate market to crash? And that is what every YouTuber, Instagrammer, everyone who's a Bitcoiner has been trying to go on my TikTok, right? So if you're a realtor lender, go on my TikTok to defend me, right? Tell me the market's going to crash because of stock market. So I've vented enough already. All right, go ahead.
No, I mean, I'm going to be as concerned. So when we had the financial crisis of 2007, 2008, which was basically thanks to like bad mortgage-backed securities, that's what caused the market to crash, right?
What
and that's
did?
why it was so bad. The housing crisis, 2007, 2008, when we had that ridiculous, basically like the mortgage-backed securities were so out of whack thanks to like bad ratings and whatnot, and everybody was invested in bad loans that were mainly mortgage loans. That's what caused it. But now we're not even talking about a bad housing market or bad loans. We're just talking about an overvalued market, and if that corrects, that doesn't necessarily mean it's going to drag mortgage or housing prices or anything like that with it, like what happened last time. Last time was a different story completely. There's always different variables in what drives the market down, and it's never always exactly the same. Like for example, you brought up the gig economy, right? The gig economy is a new thing. It has been around forever, and that's been kind of helping boost things a little bit because now go make or drive for Lyft or Uber. That hasn't been an opportunity that's always been around. So that might have also helped with the recovery. Being able to out a room in your house just to kind of help with your mortgage payment if you need to, or space or whatnot. So no, not be so concerned. Property values declining if we had a market crash. And let's talk about market crash. It's if we're correcting at a 20%, that's not really a crash. It's just a correction. It's natural. things kind of have to come back into order because, if it's overvalued, it would have to correct down to, fair valuations. So no, I wouldn't be too worried about housing if anything happens to the market, especially with all the supports that we're getting from the central bank. They're always going to jump in, and try to bail out if there's a company that's going under that's huge, like let's say Ford or Boeing or one of the airlines or anything like that. So it's never like, oh my God, the sky's falling, like it's gonna be the end of the world. I'm gonna lose like 50% of my equity. None of that. I would not be as worried about it as you would like see if in the headlines, because the headlines, that's all they do. They want to clickbait. They kind of want to get you scared. They want to run your emotions like, oh, this might be the end of it. Like this is gonna be so bad. It's gonna be worse, the worst thing ever. I wouldn't overthink it. I wouldn't stress about it. Because at the end of the day, it might never happen, right? There's always that chance of it like not happening again for a long time. Like let's say 10 or even 20 years. You never know. You can't time the market, and even if you can get close enough, you don't know how bad it's going to be, and it might never be as bad as you think. What you can do is you kind of like figure out like, all right, cool, we've had a good economy for a while. We've been running pretty smoothly. We're going to need a correction because things have been going so well, like that things are starting to become overpriced. They're going to have to come down a little bit to kind of, it's just how it works. Supply and demand, when prices shoot up too much, you kind of start losing demand and then it comes down, right?
Do you think prices have shot up a lot? Because, a lot of these people I see are in the comments right now, they feel prices are we're overpriced, right? In my opinion, if you're overpriced, that means no one would qualify, right? Back then when things were overpriced, people went stated or they got interest only loans on 2-year fixes, right? Mm-hmm. So how are things, I want to understand for myself and for these people, for them, maybe it's a personal struggle in their own life and they just can't admit it, but how are things overpriced? Because I'm thinking, if things were overpriced, why would people not? Then no one would qualify. But right now on a house, majority of people are doing financing, right? One out of every 4 are paying cash, right? So 1 out of 4, that's high, right? So the other 3 people, right, who are buying these houses, they're getting loans. That means they would have to qualify. So why are people saying that? Especially you're from the millennial generation, right? How are people saying homes are overpriced or things are overpriced if people are qualifying and they're willing to make the payment? And it's not some people, a lot of people, just not the people complaining about it.
I mean, what's overpriced? Yeah, home prices have shot up tremendously. I got a couple of friends of mine that are looking to buy newly built properties inland, right? Because they're cheaper. But I mean, it all depends on what you do and what you're looking for. So that whole overprice, it just depends on where you are in the market. For some people, it's not too bad. For some people, they might see like, oh, this is actually a good price, considering that over the next 5 years, I might get a good return on it. For others, it's like, well, that is just too expensive for me. That doesn't mean, just because it's too expensive doesn't mean it's overpriced, right? Like a Gucci bag is expensive, but is it overpriced? Or is it just expensive for some people?
My wife's eyes is not overpriced, but in my eyes, I think it's overpriced for sure.
So I wouldn't look at it as overpriced. I would look at like, where do we see ourselves going in the next 5 to 10 years? And if you're buying long term, then it's never really overpriced. Yeah, you might be able to buy it at a better price later on, but how much lower are you looking? Like 10% cheaper, 20% cheaper?
I think a lot of people are thinking the prices are going to drop 50%. I told them there's no way. No way.
I wouldn't say that. I mean, that would be like Armageddon. That is the sky falling.
But that's what I tell you, right? For those of you who think prices are going to drop 50%, the Armageddon, you who have a job are probably going to lose your job too. You with all the money in your bank is probably going to be worth nothing. If things drop to 50%, everyone's screwed.
We're in big trouble.
Everybody's screwed. If prices drop to 50%, unless you live in a shell and you are living off of like literally squirrels out in the forest and everything, if it dropped to 50%, everyone's screwed. Yeah. I can see at most, when the feds taper off and they don't buy mortgage-backed securities, right? Mortgage interest rates will climb up, and then payments will be too high, where a lot of people are like, dude, this is too rich for my blood, and back off. And when they back off, prices, instead of going at the velocity it's going at, is going to stop, right? Because once it stops and slows down, more people who were at that limit and they start making more money we'll push it back up again.
It'll catch up. It always catches up. I mean, it's just a cycle. It's always, you got the tops and the bottoms, but even the tops and the bottoms, I wouldn't say like down the bottoms like 50%. That would be insane, and that would be pretty bad. Like we would be, in trouble if that happens. But I don't think the central bank would ever let that happen, even if it comes to it. But that is pretty. I would say if that happened, maybe 10, 20% tops.
Yeah.
But that's about it. And as far as like opportunities go, like we're like if we're looking at like Orange County, for example, which is very well developed now. That's it. Now you got to get to the next location that's just developing, that's just in its infancy.
I don't think people want to move out far away because it's like accepting in their mind defeat. Like, dang it, I couldn't hack it here. I'm not saying everybody,
it's not defeat,
but some people like
it's timing.
To me, it was like I couldn't live in Irvine. I went to Tustin. I put my tail between my legs, and I was like, you know what? Let me go to Tustin, right?
Yeah.
So it's like to me, it was like, you know what? I can do Tustin. Let's do Tustin. Irvine, it was like one city over, but man, the price is like $200,000 more. Like, you know what? Let me pump my brakes. I'm gonna be all right living in Tustin, right? So I agree with you, right? But I think a lot of people are thinking they want a price drop. So let's say prices drop 20%. Let's make it easy, right? On a $500,000 home, if prices drop 20%, it would be $400,000. I'm just throwing out numbers. Doesn't mean that's where it's at. So if on a $500,000 home, 5% down is $25,000. On a $400,000 home, 5% down is $20,000. So there's a $5,000 difference with a $20,000 jump. Well, your payment will be cheaper. So you guys know.
How much cheaper would it be? If
it wouldn't be cheaper because every 0.5% that prices go down, rates go up 0.5%. So prices drop 10%, rates go up 1%. If prices drop 2%, 20%, rates are going to go up 2%. So instead of being a 3% interest rate, you're going to be at 5% interest rate. If you throw that into an amortization schedule and you put it line by line with a $500,000 at 3%, $400,000 at 5%, you're going to pay more interest in 30 years on that 4%.
You want the lower interest rate. And that's another thing too we haven't really got into is the fact that it's almost certain that interest rates are going to be going up over the next couple of years.
That means prices should be going down.
Yeah, and the Feds already came out and said it, like 2022, quarter Q1, they're going to start hiking rates. So you want the lower.
So say that again. When are they hiking rates? When do you feel like they're hiking rates?
I believe they said Q1 of 2022. So next year, first quarter, they're going to start hiking rates. They have to start hiking rates. So and as Minh just mentioned, you want the lower interest rate because you want to pay less interest overall. So that's another thing too. If you are looking for something long term, I would say now because rates are as low as they're probably going to be for a long time, unless you want to wait another 10 years or so to get back to where it is now.
That or if let's say you can weather the storm, right? Let's say you think prices are going to drop 20%. If prices are going to drop 20% and 5% down, the difference between 500 grand and 400 grand is a $5,000 difference. If you're waiting for prices to drop 20%, you better be saving more than 5% down to make it worth it. Because if you're paying a 5% interest rate, you better be coming in with 20% down. So 20% down of 400,000 is $80,000. So unless you're dropping an album that's going platinum, or you're curing cancer, or you're writing the next Harry Potter book, 20% is hard to come by within a couple years, 2-3 years, unless you're living at home with your parents.
Yeah, and that's the thing too. And we were talking about that compared to a $5,000 difference. If the house goes down so like 20%. So that's definitely something to take into consideration, is focusing more on the low interest rate environment than on the maturity of the price of the area, because every area is going to mature once it's fully developed. Like New York, for example, it's one of the most expensive places to live, right? It's fully matured. It's well established. Now you gotta venture out, find a new area that's being developed, that's gonna get built up, it's gonna become crowded, it's gonna be the next investment over the next 20, 30 years, for the next generation, right? It's just all about timing, right? If we had been in, Orange County 30, 40 years ago, great opportunity, but that's it. That's past. On to the next.
So before I get into Q&A, so you have questions regarding the stock market or mortgage questions, just ask. But So Aziz, I know you are a financial strategist. I know Aziz is going to look at my Franklin Templeton account. I have a mutual fund with Franklin Templeton, and right now his biggest fear is he's talking about is my mutual fund because it depends on right now if the market, if this Wells Fargo thing happens and the market crashes, where is my retirement being allotted right now? Can you share a little bit about what you're looking for when you're looking at retirement funds? Where do
So
you feel that it's bad that you think most people have their money put right now?
so these days in the environment that we're talking about rates going up, when rates are going up, your bond portfolio tends to go down. It's just it works in opposite. So if you're in stocks and let's say there's a good market correction, let's say 10 to 20%, and you're also holding bonds, those are going to be going down because now with the low interest rates, they're going to have to compete with whatever new bonds get issued with higher interest rates.
So most
We
people
can
I
do a
think have
video.
401 most people have 401ks and IRAs.
Yeah.
What should they if they crack open their retirement tonight? What are they looking for to know that hey, we need to call our brokerage and move our money right now?
Not move everything, but you need some exposure to some commodities. Whether it's like livestock or metals, like so. You need some sort of hedge that's going to help you out, or at least dampen a drop if you are fully exposed to like equity or fixed income. That's what I'd be looking for. You want to be like among like divided amongst the four, which is like commodities, equities, or like stocks, basically fixed income such as bonds, and then also like gold, silver, so on and so forth. And I'm not trying to sell gold or anything like that, but it it has not been replaced by Bitcoin, basically. Because like I've had a lot of people tell me that it's not. It is a physical asset, right?
Mhm.
And it's very limited. You can only mine so much. So it's always a good hedge in times like this where you have a fair probability that we might have a drawdown in the next couple of months to a year or so.
So guys, get
Um,
your retirement and look at it and see
yeah,
you might need to start moving some money. Call your brokerage account. All right, so let's
you
get
just
some Q and
want.
A. Anything
Go
else, any
ahead.
final words before I give some Q and A?
No, go for it. Jump into it. Let's see
So
what we
Q and
got.
A, we got some mortgage ones right here. We got approved for a conventional loan. Richard Veretta, we got approved for a conventional loan, but we might qualify for a USDA loan. Will that be a better route? What's mortgage? So, Richard, I think if you got approved for a conventional loan and you have good credit, I like conventional loans more. That gives you more flexibility. With USDA, there is monthly MI, just like an FHA loan. The MI is a lot cheaper. It all depends on your credit. Credit is everything when you want to compare government versus conventional, unless it's VA. Hopefully that helps you out. Darwin, very scary. The last one, Wells Fargo freezes credit line was in 2008 crisis, right? I hope things crash because prices are ridiculous. We already said that. Freddie, a bank getting conservative and pulling banks back usually creates a panic in the market. So we should see something change in the stock market very soon. So that's a question Freddie has. A bank getting conservative and pulling back usually creates a panic in the market. So we should see some changes in the stock market soon, right?
No, this that shouldn't cause panic. Not right now. It's if they start limiting certain activity, like such as like margin, because you can trade obviously with like JP Morgan or Wells Fargo, and if they start limiting their margin and they start limiting like money transfers and so on and so forth, that would cause a panic. Like you'd have like a run on the bank basically. But right now we're just looking at it as like they're just shifting their strategy just to kind of like help their revenue or their overall profits. So I that by itself would not cause a panic, not
All
right
right,
now.
okay. All right, thanks, Freddie. Nancy, can I spend the money and not pay it since they are closing it? I have one for $10,000, but I don't use it. If you spend the money, you gotta pay it, Nancy. I don't. If they close it out, you spend it, you gotta pay it. Someone has to go first. The liability managers have been overextending, and this is just a beginning. So RW says someone has to go first. The liability managers have been overextended, and this is just the beginning. Next, they will start cutting consumer credit card limits, raising interest rates on credit cards and loans, and decreasing interest on saving and CDs. Do you believe all this?
I wouldn't say they're going to decrease just on CDs and savings. No, it would be in line with the interest rate environment that we would be in. So the reason why like rates like paying back on CDs and savings have been like this crap completely is because we have been at like a near zero interest rate environment for the last, however many years that we've been in.
So none of this
no.
will change savings and CDs right now because we're at 0% environment right now with the Fed
Yeah.
loaning out money.
And we're definitely not going into like a negative interest rate environment like Switzerland is, or Germany or so on. So
all right, so you don't see that changing. Lang Saban, when refinancing FHA to conventional loan, do they also check again employment? Yes. If you are refinancing, if you're doing a brand new refinance, a real rate term, not a streamline, they will always verify income again. Hopefully that helps you out. Even if you have 20% equity. If you have an FHA, don't forget, when you have an FHA, you probably have a high debt to income ratio or a low credit. If you go from FHA to conventional, they're going to, if you even go FHA to FHA, but you don't do a streamline, they're going to want to re-underwrite the whole file, income, asset, credit, and even if you have enough equity. Hopefully that helps you out. Then the other banks will follow suit. We'll see our RW if the banks follow suit, right? It is week one. We will see.
So that would be an indicator right there. If they do follow suit, that would be an indicator as to why they're doing it.
I already called some personal bankers over at Chase and some of these other banks, up in upper management. They said they're not doing anything right now. Right? They said everything's fine. To me, my telltale sign when they do away with PMI and equity line of credits and they require 2 appraisals. So, I actually witnessed a declining market. They cut off. Oh, so in a declining market, you can't even buy a home 5% down. They want you to do 10 or 20% down, right? Because A, there's no PMI companies, or number 2, right? Down. In a declining market, they want you to come in with a bigger down payment in case the market does decline. So
it drops,
So if you buy in a declining market, if you can even right now in a declining market, think about this. Hedge funds are buying homes over asking price right now. You don't think in a declining market, they're going to buy these declining homes at a higher velocity? For a consumer to get a home at a declining market is going to be really hard this time around. Any refinance, they look at employment? Yes, they do. Okay, we're there. Glee, and thank you for answering a question. 6%, Freddie. Most full doc. Thank you so much. What is 6%? What is the effect on credit lines? Is credit scores? Let me see here. Banks need to start drumming up business by giving away their toxic asset to new account owners. So what's the timeline on waiting? Let me see here. That takes the asset off their balance sheet, and the new account owners either flip the property or or have a place to stay. Either way, the government is gonna sell taxes. Getting sale taxes. Yes, that is true. Margin calls is going to happen. So margin calls are going to happen.
Margin calls. Yeah. If we do have a market decline with how leveraged people are right now in their brokerage accounts, there are going to be margin calls.
Hey, question asks you, can there be a crash in the stock market, but not a crash in real estate?
Yes. I mean, it's what you consider a crash. So yeah, the stock market can decline heavily, but the real estate market will still go down with it. It just won't go down as much or won't go down as bad. But yeah, there will be like less people, like less demand, if that is the case.
So he feels there's less demand, but it's not going to bring down the market. Remember, when people upgrade, it is a luxury, not a necessity. So if housing market declines, people just need to sit and make their mortgage payment. And like I said, their mortgage payment is cheaper than rent. Back in 07, 08, people were forced to sell because they couldn't afford their mortgage payment because they went stated. So when their loan adjusted, they couldn't afford to refinance because they couldn't afford the payment again, right? And because they couldn't afford the payment, they had to let the house go. So when they let the house go, back in 07, 08, it's 100% financing. And when people cashed out, they cashed out to 100%. We are sitting on $33 trillion in home equity and $11 trillion in mortgage debt. So we have 2/3 the equity we have now than we didn't have in 07, 08. We're at like 110% LTV, 90 to 110%, right? Remember, 2.6% of homes or mortgages right now, right, are negative. 2.6%, 450,000 homes only. So should we cash out refi? Berlin, I would cash out and refinance if you're going to pay off debt just to drive down your debt to income ratio. Don't forget, it's a 30-year fixed loan. Why not? Or if you've been in your loan for 5 years, you can do a 25-year fix. You've been in your loan for 10 years, you can do a 20-year fix. So you don't have to start all over and still cash out and minimize your debt. Should you buy When your enemy contrasts, you should expand. Yo, should buy. Okay. I know I should buy, but where should I get the cash from? There are high probabilities of a crash from 2002 to 2007. Just saying. So the high probability of a crash, right?
Yeah.
So and the crash would happen. So when back then, I don't know if anyone has looked up their history yet. People who got loans in 07, 08, a lot of them got either option arms or 2-year fixed adjustable loans. They're allowing people to buy a home with a 600 credit score. Another numbers to throw at some of you guys. So in 2020, the average FICO score to buy a house was 711. You can Google it, right? NerdWallet will spit that out to you. In 2021, the average FICO score to buy a house is 730. Also, did you know in 2021, the average debt to income ratio to buy a house nationwide is 40%. The average LTV is between, right, 80 to like 83%. So people are coming in with bigger down payments. As most of you guys know, only 30% of homes are bought by first-time home buyers. That means the other 70% are upgrading from one property to the next. That means they're using equity. That's why LTVs are so much lower than they were back then. So know these numbers that in 2021, most of these people who are buying that has a chance of losing equity are coming in heavy on equity, low DTIs, high credit scores. They're responsible buyers. In 07, 08, 02 to 07, 08, irresponsible buyers. Yes,
That's
lenders were negligent.
Yeah, that was a huge difference too. That was a huge difference between like why the housing market crashed so hard back then versus why it wouldn't crash as hard right now, because it was bad pretty back then. I mean, you had, like you said, stated income, people who didn't really qualify, and you had arms. So it's a completely different story for housing market now. Yes, it's been going up like crazy, but they're not bad loans basically, like it was.
Let me see here. It's different market now. Everyone's just commenting. Most investors. I think that's it. So guys, that's it for us tonight. Aziz, thank you. Daniel Aziz, thank you for being on. So
Thank you for having
what
me.
I'm gonna do is I'm gonna have Daniel Aziz on a little more often. So we'll probably have him on next month. We're gonna go over the market. So we're gonna go over a couple things, right? So next month when he comes on, I think we're getting closer. As we're getting closer to the end of September is when we're gonna see who was right and who was wrong. When all this free money goes away, where will the stock market be? Where will the real estate market be? Right? We will know. So every month we're gonna have Daniel. Daniel's gonna give his side on the stock market and where the market's at. He's gonna go over. Right? I think I'm gonna send him my Franklin Templeton tonight to make sure that they're moving my money around somewhere, because I gotta make sure my son's college fund and life fund doesn't get dissolved, right? Hopefully that brought you value, right? How do they get a hold of you, Daniel, if they want to ask a question? Do we have his information up?
No, we don't. Yeah, you can email me at contact@wealthjoe.com. That's
DM me and I'll send you his contact, guys. If you are interested in having him review your retirement, he'll give you advice. Should you call your broker? Move it around, right? Or leave it alone. So message us and we will send you his contact tonight. But you know how to get a hold of us? 714-790-9697. Email us, info@whatsamortgage.com. But guys, hopefully you enjoyed the night. Guys, if we brought you value, do me a huge favor. Save this video, share this video, and like this video. If you made it to this part of the show already, and if you're not following us, phooey on you. Hit that subscribe and notification button. All right, guys? And we want to end all our episodes with our attitude is gratitude. Without you, there would be no us. So thank you so much. Thank you again, Daniel, and have a great night, guys.